We're really excited to be relaunching this portfolio. This is something for, I think a few of you have been around on this long enough to know we've been working on this since December. This project was initially pitched to us as a pocket listing from a close broker of ours in December. Took us a couple months to lock it up between negotiating and getting the contract signed and everything. And then here we are several months later. We did end up relaunching this offering, as again, many of you know, we put it on hold for a few months due to the macroeconomics that have been impacting many commercial real estate projects. I'm really excited to say that the reason that we're back with this is not only have we gotten a retrade where the price is slightly lower, but we've also gotten some really favorable bank financing terms, and even better, we've got some favorable seller financing terms in here. So all around, this deal feels very different than it did a few months ago, but it's also super familiar because we've done a ton of due diligence on it already, and we really know what we're buying. So we'll jump in and talk a little bit more about that as we go. Just real quick, this is a private placement offering, and it's actually a 506C, which means that all investors need to be accredited. I'll talk a little bit more about that process in a moment. If you happen to be someone that's not accredited, still stay tuned. I think you'll learn a lot about us and our offerings. We do have projects regularly that are available for unaccredited investors as well. So stay tuned for that. Just quick house rules. If you have questions, we're using Zoom Webinar, which actually has a Q&A feature, which makes it super easy for us to track questions and make sure we get to everybody. You can always chat as well, but it's just a little easier to keep track if you put it in the Q&A section. We will watch that live, but for sure we'll answer everything at the end of the presentation. And if anything contextually makes sense where we're at, we'll pause and answer questions as well as we go. We're also recording this, obviously. We'll be putting this on our YouTube channel by tomorrow morning and sharing it out with everyone. So you'll have this full recording, as well as this whole deck is actually already available on our investor portal now for you to download. So here's our quick agenda. We'll talk a little bit about ourselves, our investment philosophy, talk about the investment highlights with the portfolio, and then go dive into the portfolio itself. Talk about why this is something that you should be investing in, or at least highly considering it, market, our business plan, all the good details. So just jumping right in, a little bit about us. So Ryan, Matt, and I are the key principals on the project. I am the CIO, so I mostly am responsible for the investments, finances, overall legal structure, things like that. So I really set up the syndications, make sure that they're running, oversee a lot of aspects, obviously, of the finances for all of our projects. I have a background in corporate finance as well as education in finance and business. I've been doing real estate investing for over 12 years. Specifically, I've been in the syndication space for about 3 years. I initially started off working with several other operators as a underwriter and really became someone that was leading acquisitions for a couple different groups. And that's really how I learned all about the backgrounds and finesse of commercial real estate as well as syndication opportunities. Ryan and I met each other a few years ago. We're actually neighbors. We live, quarter mile apart from each other, and we bought our first mobile home park together just over 2 years ago. And since then we're at the point where we have 14 properties under management, with about 7 or 8 more under contract to close this quarter. So we're just, loving the dream, working with the commercial real estate. Ryan's got a strong background in residential real estate primarily, but has been in the mobile home park space for several years now. And he actually just retired from his previous job of being an elementary school principal and is now a principal at Suncrest Capital instead. Yes, we like puns around here. Matt, I'll let you introduce yourself. I never do you justice with the intro.
No, that's fine. I've been investing in real estate for the past couple of decades. I started in single family homes and condos in the northeast part of the US, but more recently, and especially, I've been working with Brett and Ryan over the past couple of years, where been focusing on mobile home communities, RV parks, and some retail mixed in there as well. I tend to support the team really working with Brett to underwrite all of our deals. We have this process where like I'll kind of go in one corner and then he'll go in another corner. We'll underwrite and then we come back and compare our assumptions and the results. And I think this process has worked pretty well for us. We've been able to close on a lot of deals that we've liked, and I think we've passed on many, many more that we didn't like. And then obviously with the mobile home parks that we own, and as well as the retail and the RV parks, you know, I think we all play a part, and I certainly play a part in the operations of those as well. So
cool. Thanks, Matt.
Yep.
Have a few other employees. We actually have 5 full-time, 1 part-time W-2 employee now, with a few 1099 full-time contractors that work with us as well. It really helps us scale much more. So Ali and Trip handle investor relations, finance, reporting, things like that between the 2 of them. And then we have Doug and Kristen and Sarah, who are our regional management team, as well as project. One of them is our project director, and those 3 are all based in the Midwest. Each of them is within 3 hours of all of our properties. So again, that's really helped us be able to scale, especially in kind of the specific markets where we focus. On that note, speaking of markets, Ryan, I'll let you take this one.
And speaking of Midwest, you can see that's where most of our properties are. We like the economy of scale in the Kansas City, Springfield, Missouri, and Des Moines areas specifically. So we've built an excellent team there, which Brett alluded to, and we'll talk about a little bit more. So our current holdings are in the blue there, and then we have our Springfield portfolio 2 in the orange. There's 6 communities. I'm right outside of Ivy Acres, actually. So a little later, I'll try to turn on my webcam so you can get a little glimpse of it anyway. So I've been on site all day looking at reviewing all 6 properties. We have the 2 mobile home communities up in our neck of the woods in Sun Valley, Idaho. And we just closed on our very first RV park last week, just south of Kansas City. So we're excited about that one as well. And then you'll see in the Des Moines area, Jasper Point Plaza is our first retail center that we closed on a few months ago. Wanted to talk about our relationship with VeriVest. It's a third-party company, and they put sponsors through a careful due diligence process, ongoing portfolio monitoring, and they have us as principals agree quarterly to adhere to their code of conduct. So just wanted to let you know, and you can find us on VeriVest, that we've been vetted and verified through VeriVest. So hopefully adding an additional level of confidence for our investors. And we are very excited to announce that we have excellent co-sponsors on this project. So some might recall we had a co-sponsor relationship with FTW, and they're based out of Kansas City. Through the process and discussing further with them, they have a lot of experience in apartments, not so much in mobile home parks. We decided to continue developing a relationship with 3 pillars who have extensive relationships and experience in the mobile home park space. So Daniel and Joel, brother-in-laws, so they started FTW back in 2017. Daniel is a 3rd-generation mobile home park owner, so a lot of experience, grew up in the space. 43 communities in 8 states, a little over 4,500 spaces. So we're very excited to be partnering with them and lean on their experience, and they're excited to be working with us as well. They've partnered with us on a number of deals, so they've invested in a number of our deals. They've seen how we operate, and they were all on board for participating in this project as well.
Okay, so I get to do the fun part, talking about the investment highlights that I think everybody's here for. So again, this full deck is available already on our website, just suncrestcap.inv sunportal.com. See, now I can't even remember the whole thing. If you go to suncrestcap.com, that's our main website, and you can actually just click investment, and it'll take you to our syndication pro portal, which is that other URL that I was quoting. So we're looking at a 19% IRR. As of today, we're actually projecting 19.3%, which is what the plus is. And I'll talk in a moment about some of our key assumptions that actually we think it'll be higher than that. We're looking at a 10-year hold. So have the whole project for 10 years, but at year 4, we'll do a cash out refinance and expect to return 84% of your capital. I've got a table that'll show that to kind of walk through it a little bit more on that. We've restructured some of the deal a little bit based on some feedback from investors. So we used to be offering an 8% preferred return, and we've increased that to 9%. And we've also cleaned up the promote structure. We used to have a tier structure. Now it's simplified to just a 60-40 split above the 99%. So what that means is everything, all of the cash flow that comes from this property is paid directly to investors until investors receive a 9% return. So that's as guaranteed as it can get, that 9%. And then anything above that is split 60-40. So really a ton of upside still that's reserved for investors. And that's where that 19% projection is coming from. The other thing we've done is we've reduced our fees quite a bit. So it's traditional in a larger portfolio like this to have acquisition fee plus a loan guarantee fee, especially in the case where we're guaranteeing recourse debt, which is what's happening here. And we've actually lowered our fee from 3.5% to just 2% total. So really leaning that out quite a bit and making sure we're giving investors as much as possible. Projecting 3.2 equity multiple on this. I'll explain a little bit more of what that means in a moment. And then we personally will be investing 5% of the equity ourselves. So this will actually come from us. So you know that we have skin in the game from 2 perspectives. 1, we're co-investing with you, but 2, we're actually signing on the debt, which in a lot of ways is a lot scarier than just investing money. So want to make sure everybody knows we have a huge alignment of interest, and we want to make sure this is even more successful than what we're projecting. So this is our cash flow. We always do it based on a $100,000 investment because it's just easy to extrapolate that. If you have higher or lower, you can interpolate it. But the first row is the capital invested. So of course, at the beginning, if you invest $100,000, you'll have $100,000 invested in the deal each year until after year 4, we'll do a cash out refinance. So after year 4, we'll have paid back about 84%, or exactly $83,778,000 will be paid back to you. And then you'll have only $16,000 left in the deal. So what's awesome about that is you are getting so much of your capital back that you've basically de-risked your investment because your whole investment's been returned to you. But along the way, you've already received $5,000, $6,000, $7,000, and another $18,000 in cash flow. So really, by then you'll have already received more than your investment, and then be de-risked quite a bit. And then from then, you're still receiving your pro rata portion of the cash flow going forward. So you'll see these percentages based on the amount actually invested get quite high. And then in year 10, where we're projecting a sale, you'll still get $16,000 in cash. I'm sorry, $3,800 in cash flow based on your $16,000 investment. And then based on the ownership in the deal, you'll get another $162,000. So on this slide, I mentioned the 3.2 equity multiple. If you were to add up all of this cash flow and then these 2 capital payments and then divided them by $100,000, that's where that 3.2 metric comes from. So it basically over the life of the investment, we're projecting that you'll triple your investment from cash flow and capital events. The last thing I want to touch on here is our sensitivity analysis. So for those of you doing commercial real estate for a while, we get in the habit when we're looking at deals. For me, at least, the first thing I look at is the exit cap rate assumption. If anybody has questions about how cap rates work, just drop it in the chat. We're happy to talk about it. We actually have slides that explain this in more detail. But for now, I'll just kind of jump in with the cap rate assumption here. So 6% cap rate is very conservative for a portfolio like this for a number of reasons. One, going in, we're already 91, 92% occupied, actually 95% occupied. We'll show that in a moment. We're 95% occupied day 1, and within 2 years, we'll be 100% occupied with more pads added. So we'll be at 465 lots, 100% occupied, all within the same market. And on top of that, we actually own 4 other communities in the same market. So that's 10 communities we'll be able to sell at the same time. So the cap rate really should be very, very low compared to this, but we're projecting conservatively 6%. Just to give you an idea of why this is super conservative. This last quarter, Open Door Capital, that's Brandon Turner and Brian Murray's company, just purchased a portfolio in Springfield. It's 525 units or lots, so a little bit bigger than ours, but the occupancy is only 60%, so much lower. But it appraised at a 3.8 cap, and that's actually, they bought it for that. It appraised at that, so over $24 million purchase price on that portfolio, which would be incredible today. We'd already have significant equity going in. So again, just I'm harping on this, but really want to point out we're looking at a very conservative cap rate. But on the downside, this is like literally impossible to see a cap rate as high as 8.5% on something like this. Even 7.5 is really unlikely. So you're still seeing some pretty good returns, really 16% IRR, 2.5 equity, even on the very, very unlikely side. So this is in my mind a very safe portfolio. With that, I'll turn over the time to Matt to talk a little bit more about the portfolio itself and the properties.
All right, cool. Thanks, Brett. Yeah, I'm going to talk about the different communities that we're planning to purchase as part of the Missouri 2 portfolio. I'm going to talk about a little bit about where we are now and ultimately where we're going. You can see that the Springfield, Missouri, we have parks in Springfield, Missouri and Branson, Missouri, and Springfield is just about a 3-hour drive from Kansas. Next slide. You got it. Okay. So as I mentioned before, we have the Missouri 1 portfolio that we're currently managing. We've highlighted 3 of our communities here in Springfield. We have Cedar Lane, and just 6 minutes away is Evergreen, which we acquired a couple months back. And on the other side of town, there is Suburban Acres. And down near Branson in Forsyth is Rolling Meadows, which is probably one of our nicest communities. And these are the other communities that Brett was just talking about that we plan to sell the whole portfolio together, likely at a lower cap rate. Next slide. So now here, you can, in yellow, you can see the 6 new communities that make up the Missouri 2 portfolio. So there's 4 in Springfield, which are Spring Park Estates, Lazy Acres, Chestnut Gardens, and Cedar Brook. And just about an hour drive away up Route 44 in Lebanon, Missouri, there are two of the other parks, and that's Oakwood and Ivy Acres. Obviously, with the fact that we already have 4 parks in the Springfield area and we're planning to purchase these other 6 parks, we can really leverage the economies of scale, which Ryan had alluded to earlier. We have a strong regional management team that we can leverage to further cut down our costs and really manage all of these properties effectively and efficiently. I'd also say that we're really fortunate to have a great contractor in the area that has been pretty much exclusively working for us. We're extremely pleased with the quality of work that he's been providing, and we can tell you from experience, it's really difficult to find great contractors. But he has been able to grow his team and his business with our increasing demands. So we've really created a great win-win situation here. I think the other thing that I'd like to point out with being in this area is that we've been able to develop relationships with the city of Springfield. And during our due diligence phase, we've had close contact with the city of Lebanon as well. And having these relationships with the city have really helped us, working on some of these on the projects that we currently own, as well as the ones that, as well as the MO2 portfolio. And really, it's helping in terms of, the lot development that we want to do and the infill of homes that we want to do as part of the portfolio. And, in terms of the plan that we want to do in terms of infill and lot development, we'll talk about that a little later in the talk. Next slide. So this is a really high level snapshot of the Missouri 2 portfolio. There's 465 lots, and this would bring our total lot count in the area to around 700 lots in this entire Springfield metro area. The Missouri 2 portfolio is currently 95% occupied, which Brett talked about earlier. So this is not going to be necessarily a super heavy lift for us in terms of infill, but there is some for us to do.
Sorry, Matt, I was pulling up the chat window and I think it blocks the screen. So you should be good now.
Yeah, okay. So sorry, like, okay, cool. All right. Okay, I can see the right slide now. Okay, so on this slide, actually, we're going to, okay, this is where I'm going to dive. I had a different slide up. I'm really sorry about that. So on this slide, we dive a little deeper into each one of the parks. And I'm not planning to go over each number, but in the top line, you can see the pad counts for each park. Okay, I'm gonna point out here that currently there are 60 operational pads in Ivy Acres. However, one of the first order of business is going to be to develop 20 of the pads in this park. And we've had extensive conversations and agreements with the city of Springfield. So we're really ready to go here. The next line shows the number of tenant-owned homes and park-owned homes. And for the portfolio, we currently have 425 occupied pads. And under that, you can see the percentage of occupied pads in each park. And as I mentioned before, we are currently 95% occupied. Next are the lot rents, and just under that are the market rents. I want to mention here that in the beginning of July, all of the residents had a $40 bump in rent. Next, I would say a big part of our strategy for this portfolio is building back the water and sewer. This is currently not done at 4 of the parks. So one of our first order of businesses is going to be to go in and invest in the infrastructure to kind of fairly charge back water and sewage in the parks. And we do that by installing Metron meters. And talking about that, though, it really kind of brings me back to bringing the rental rates up to market. We realize that we're trying to come in here and we're going to start charging our tenants for the water and sewer that they use. We know that this is ultimately going to hit their bottom line, although they do have the autonomy to, kind of regulate the usage of the water and sewer. But to that end, we're also projecting a minimum to no pad rent increases in the first year of the property. So we're going to go through a year and then not have large rent increases after that. And we've said this to our investors before. It's not necessarily our intention to get rich off of jacking up the rents on our tenants. We take a lot of time, effort, energy, and we deliberate a lot when we analyze rent increases. So ultimately, at the end of the day, it's important for us to have communities that are affordable and in a place that our residents are really proud to call home. And then finally, the last kind of part of this slide talks about the single family home median home price. And when we look for different communities, we want that to be above 100K, and we'd like the median income to be around 40K. And both Springfield and Lebanon meet the criteria that we're looking for when looking at communities to invest in. Brett, you can go next, or next slide, please. Okay, and then finally, this is just a breakdown of the lots that we have. So of the 465 lots, 80% of the lots are resident owned homes. 13% have homes where the resident is on a lease to own contract. 4.3% are vacant homes, and about 5% are undeveloped lots. Next slide.
Thanks. Sorry, Matt. I realized I did skip a slide.
You skipped a slide.
I totally messed you up.
Yeah, it's all right.
Okay. I think we're good though. Go ahead, Ryan. Assuming your bandwidth is working at Ivy Acres.
Yeah. Can you hear me okay still?
Yep.
Okay. Awesome. So just want to go through the advantages of investing in mobile home communities. Supply and demand is a big reason. The supply of communities decreases every year. Nationwide, roughly 100 parks a year are repurposed for commercial or it can be apartment buildings, whatever it might be, and roughly 10 are built or expanded on in a significant way per year. So the supply continues to go down, and we know that affordable housing options, the demand for those is always on the rise. Recession resistant, especially during COVID, when economic times, we experienced that the uncertainty, and mobile home communities and self-storage were the two best performers. That between 92 and 95% collections, they went back and forth between number one and number two, where like retail essentially was around a 50%. Sorry, I have messages coming through, about 50% collection rate. So it's proven even in recent history that we have a great recession resistant product. The significant tax benefits are a huge deal for investing in mobile home communities. So they are on a 15-year depreciation schedule, which is much less, sometimes almost half. Some assets are closer to 30-year depreciation. Mobile home communities, it's an accelerated rate on depreciation. So, and we also do a cost segregation study to help with the bonus depreciation that we pass on to our investors. So typically when we underwrite, we put a 60% depreciation back to our investors. So on a $100,000 investment, you would get a paper loss on your Q1 of $60,000. But our actual history is much better than that. So last year for our Iowa portfolio, we were able to deliver an 80%.
Ryan, did we lose you? Okay, I'm gonna go ahead and jump in for Ryan. I think we just lost him. He's literally at one of the communities right now. He's been doing our third due diligence trip this week. So what he was explaining on the tax benefits is last year, what we saw in practice was we were able to deliver 80% bonus depreciation to one group of investors and 130% in our other fund that we had last year. So we always try to stay safe and tell people we expect 60%, but the reality is generally much better than that. So it ends up being a really great benefit. And this actually comes from the Trump Jobs Act. And the reason I bring that up is this is the last year that we'll be able to see 100% bonus depreciation. Going forward, it's going to be phased out by 20% every year until zero. So really a great year to be getting into real estate. So talking about the markets, Ryan, are you back? Yep. Okay, go ahead, Ryan.
All right. So markets, let's hit Springfield first. So as Matt said, we look for that 40,000 higher median income, 100,000 or higher for median home price. The reason for that, if we're bringing in units that are $85,000 to $90,000, we don't necessarily want to be competing with single family homes on private land. population wise, we look to see 100,000 or more. So Springfield, all those boxes, is a diverse economy. So for healthcare, education is huge. So you see the list of universities. Almost every major intersection, there's a sign for a university. So it's a very strong economy with education, healthcare, manufacturing, etc. So the other one for Lebanon, where I am in Lebanon right now, I'm going to attempt to turn my video on to see if this will work. Can you see me okay? So we're outside of Ivy
You're
Acres.
not on,
I don't know
your
if it's
video's
coming
not
through,
on
but
yet. Oh, we just lost them again. Oh yeah, sorry everybody. I'll go ahead and finish this up for Lebanon. So Lebanon is just 45 minutes from Springfield. And frankly, when we first looked at this portfolio, we were all nervous about the fact that 2 of the communities were in a smaller city than Springfield. And furthermore, what's really interesting is if you remember back to the slides, Matt was showing most of the vacancies are actually in Lebanon. So that made us extra nervous of, well, how are we going to fill this up? So what's actually a couple of things are really cool about Lebanon. It is like a massive manufacturing hub, and it's Springfield, as you can see here, is among the top 5 fastest growing small cities from a jobs perspective, and they're actually struggling to fill a current vacancies. So there's just tons of jobs in this market. Ryan, did you come back? I just want to have you talk a little bit about Lebanon industry and the kind of jobs that we're seeing there.
yeah, and I moved to hopefully get better reception. So
You sound better. Yep.
Yeah, you're not going to see a mobile home in the background. Sorry, but yeah. So Lebanon, it's known as the aluminum boat capital of the world. They have 2 major boat manufacturers. So the city, the workers for most of these jobs they're commuting in, and the city is hurting for affordable housing. So they've been more than generous with their time, information, and support of adding additional mobile homes in our communities, and even expanding a couple of our communities up here. So it's one of the top 5 fastest growing for job growth in the country. Even though the population is lower, it's 45 minutes from Springfield, and it's definitely a growing area. So we're very excited for Lebanon, and I'll show you another reason why in just a couple slides. So just quickly looking at the income year over year for both Lebanon and Springfield, good solid growth there. Home values, Lebanon holding steady. They haven't had a lot of additional home developments being built until recently. So that's part of the reason for the housing, and now it's starting to explode up here. And Springfield, like most places, home value year over year is increasing quickly. In each community, we do test ads to test demand. That's this slide here. And Springfield, very strong. What we look for with our test ads through Facebook Marketplace. So we'll list a home for sale. And if people are interested, we essentially say we have homes for sale in 3 to 4 months. So we get a buyer's list from it as well, but people will respond to a Google form, which takes 2 to 3 minutes to fill out. Through each step of this, there's filtering criteria that we're describing in the ad, and then also on the Google form. So minimum income level, how much down payment they need, etc. So it kind of filters people out a bit. And what we're looking for is at least 10 Google forms completed in a week indicates solid demand. And ours, we turn the ads off quickly because we're well exceeding that. So for Springfield, it was 13 Google forms in 24 hours. Lebanon is actually our highest performing test ad ever, and that's including downtown Detroit, Michigan, which is crazy. So I turned this off after a few hours, like 8 hours. I turned that ad off because we had such high demand. So really no question that we'll have strong demand for homes that we're bringing in to sell.
Thanks, Ryan. Okay, so jumping into the business plan, some of these points we've already talked about, but we like to put it into a timeline so you can kind of see what we're going to be doing here. First, I want to start with the right. The key upside here, these are the most important things we need to do in the first few months to really make sure that we're hitting the upside. And frankly, all of these things are things we've done multiple times across our other communities, so they're things we feel very comfortable doing. So the first is adding 20 lots at Ivy Acres. This is simply removing trees and then adding the sewer, water, and electric systems and concrete. So that really, we've already got our general contractor teed up. We've got a formal bid ready to go on that. Next is utility buildbacks. We've done this at 14 of the 14 communities we manage right now. At least 9 or 10 of them we've done buildbacks on. So we install Metron meters. What's cool about these is they're actually wireless, so we get real-time data feeds on water consumptions. And in fact, in some parks, we've actually found leaks this way where we can see that the consumption is too high, and we can see where the consumption is too high and actually find and locate the leak. So it's super cool. And that's a massive upside too, because we are able to recapture about 80 to 85% of the cost of water and sewer. We're able to recapture through this. And then add 50 new homes. This will happen over the course of 2 years to get to 50 homes. And then we'll be doing modest rent increases that Matt discussed a few slides back. So coming over into year 0, these are some things that are actually happening before we even close. So when we first went under contract, there were 8 homes that the seller was in the process of rehabbing. And we had part of the contract, he had to be done rehabbing those before we took possession of the park. What's cool is not only has he finished that, but he has actually sold all of them. So they're full. So we're walking in, you know, we paid one price for it, haven't had to change the price, but we've got immediate upside from homes that have already been sold. And then he's actually been filling more lots as he goes as well. So he's got over 6 lots that at least 6 lots, I should say, that have been filled since we went under contract. And then the seller also increased rents July 1st based on our conversation with him and agreements we've made. So again, you know, we're walking in, we don't have to worry about, typically you have to give 30 to 90 day notices before you can do rent increases. It's already in place here, so that's not something we have to worry about. Year 1, what we'll work on is adding 24 new homes across the portfolio. A lot of these are going to go into Lebanon. We'll install 298 water meters. Ivy Acres, again, we're going to do the lot development. Cedar Brook, we have found through our analysis on the portfolio as well as our historical data on our own properties that there is very likely a water leak at Cedar Brook. Their consumption is at least 2 to 3 times what we typically should see for a mobile home community. And so what we've done is we've received a formal bid again from our general contractor to go in, worst case, redo all of the water infrastructure. We really don't think we're going to need to do that at all. So we should be able to add the submeters, find the leak quickly, and then just kind of repair in place. But in the worst case event, we're bringing in $220,000 just to do that, and that's part of our budget again. So if we're closer to the $10,000 to $20,000 that we actually think it'll be, that the rest of that will just allow us to buy homes faster and expedite our business plan. Lazy Acres lot development, we've got a couple extra lots we can add at Lazy Acres as well. So when we do our due diligence trips, we really look for opportunities to add more homes and lots and make it feasible without really packing homes in, because we want to make sure we're keeping the quality of living and spacing. So looking forward to some extra upside from new homes too. Finally, in year 3, or I'm sorry, in year 2, a couple of things here. So Oakwood doesn't have paved roads, it's gravel right now. So we'll pave those. We will also be paving 274 offsite parking pads. To be clear on this, with 465 pads, most of them already, or a good chunk of them, I should say, already have paved parking. We'll be doing the rest. The main reason for that is that when all roads are paved and we have offsite parking that's paved, this portfolio becomes a whole different level because it qualifies for agency financing through Fannie Mae and Freddie Mac. And so more buyers are interested, the financing terms are better, so you can usually get a lower cap rate, all those kinds of things. So that's a strategic play on our part that even though it doesn't actually generate revenue, it definitely increases the value of the communities. The last thing I want to mention on this, and Matt talked about this a little bit as well, Oakwood has quite a bit of acreage next to it that's vacant. It's zoned and approved for mobile homes. We could add at least 110, probably closer to 150 more units there. Currently, this is not part of our underwriting. we're currently seeing this as icing on the cake. If we decide to go ahead and do this with the cash out refi proceeds, we could do this. But really, we would only likely do this if we get some subsidies from the city, which, as Ryan mentioned, the city is really suffering from a housing crisis, and they're very interested in having us develop this. So they've offered to pay 50% of the costs. So we're in negotiation to see if we can actually make that happen, because it was kind of an informal offer for them. So if they'll pay half of it, we will absolutely do it and take benefit of 100% of it. So that could be some icing on the cake that, again, we're not forecasting. Okay, so that's the gist of our offering. I do have a couple more slides that I'll go through, but real quick, the timeline we're looking at is we're closing October 7th. So our funding deadline is end of September, and we'll have our subscription documents by next Friday, if not sooner. Actually shouldn't have them up by Monday. And then you can see here the funding process. So you'll need to create an account on our website. It's just suncrestcap.com. You click on invest, and then you'll see kind of the login and account creation. You make a reservation. That's where you just say how much you want to invest. It's not a firm commitment, although we would like firm commitments at this point, because we're actually over 100% subscribed at this point. But many of our investors, many of those commitments came several months ago, so we are going back and reconfirming. So if you're interested, please get a reservation in there and let us know how firm that commitment is. Next, this is a 506C, as I mentioned before, so we will need to do an accreditation for you, and it's actually really easy. There's two options. One, you can have your attorney or CPA or financial advisor sign a letter stating that you're accredited, and we have a template. Just let me know, and we'll share it with you. Makes it easy for them to sign. The second option is you can actually go through our investor portal. There's a third-party site that's all integrated. It takes about 5 minutes. All you have to do is just prove you're accredited by either showing your paycheck or your brokerage account, or how, depending on how you're proving your accreditation. So that process is actually quite seamless. Finally, you will review and sign the private placement memorandum, the operating agreement, and then fund the investment. So really, all of that should be fairly seamless, but it is a fair amount of steps. So reach out to me if you have any questions as you go on that. Wanted to just kind of point out a couple of the benefits of working with Suncrest. So we have a really thorough and robust due diligence process that we have frankly learned over time from things we've missed during due diligence that have kind of bit us on some past projects. So after managing as many properties as we do and as many units as we do, you really start to learn some things. So a couple of things I'll point out on this slide. With the on-site inspection, we've learned to take lots of pictures. So we have a Trello board where we have a card for every single lot in the portfolio, have a picture, we have documentation, we keep track of everything that happens there, so that a year from now we can go back and remind ourselves what's the size of the lot, how big of a home can we fit there, is it electric or gas, things like that we can keep track of. We have a GoPro 360 camera. This actually lets us just at any point we can drive in and look at any part of the park, because it literally takes 360 footage, which is super cool. The other thing I'll point out, because this is something I head up, is our forensic accounting. So we actually have a forensic accountant that comes in and reviews all of the books. And what I found from my finance experience is it's very easy to, fudge some numbers from a profit and loss statement. It's quite easy to hide expenses or overinflate income, things like that. So having a forensic accountant that can go back and look at every transaction for 2 years, look at the financial statements and the taxes is huge, especially when you're talking about a portfolio this size that is really cash flow intensive. You want to make sure that you're actually getting what you think you're getting. So we've already gone through that process. Everything looked great. So really excited about that. Another really cool thing about Suncrest is we are vertically integrated. There's only 1 or 2 other operators that I'm aware of that are as vertically integrated as we are. So we have our in-house property management. So all the property management rolls up to Ryan. We have a couple of regional directors that then manage, depending on the portfolio, they manage the properties, and there's an on-site manager at each property. So that all rolls directly to us. We also have our in-house moving crew, which is kind of huge in this space, because there's a major risk of moving homes, because it could be tomorrow. Probably not, though. More likely it's going to be 6 months from now. If you put in a request to have a home moved, it's going to take 6 months. And a lot of the movers are not insured. So if they break your home, you're out that money. You're out the cost of the home, you're out the cost of any other transportation costs you've already paid for. It's just really risky business. So what we've done is we've actually bought our own toter. We've hired our own contractors that handle all of this for us. We're fully insured, and we get to control the whole supply and the supply chain for moving these homes. So huge benefit for our communities. Finally, we're a licensed home dealer and reseller. What this means is generally without a license, you can only sell 6 homes per year in most states, and this allows us to sell unlimited homes. So it's a fair amount of barrier to entry to become a dealer. A lot of paperwork and licensing fees you have to pay. So we've already done that for Missouri and any of the other states that we operate in. So big advantage again. So that's the end of our core presentation. We do have quite a few appendix slides that will be available online, or we'll jump to them during question and answers, depending on what questions come up. So with that, let's see if we've got any questions so far.
I don't see any in there.
I don't see any open questions right now, right?
Give everybody a minute to answer some questions. Okay, I've got one question here. How did the environmental assessments go in due diligence? Great question. So we did what are referred to as phase 1 assessments at all 6 communities. 5 of them came back flying colors, looked great. One of them, Lazy Acres, came back with some concerns because it is in an area where an old creosote plant existed for 100 years. Didn't even know what creosote was before this, by the way. So we actually paid for a lab to do test samples. So they actually bore dozens of feet into the ground, take samples at every different portion, and then they test them to see if there's any contaminants, mostly because they're worried about the groundwater having issues. And in that phase 2 study, that came back clean. So all 6 parks are clean, no environmental issues. Okay, since there aren't questions yet, I am going to go ahead and just answer a few questions that we generally get. So this is our FAQ. So question is, can we invest through a 1031? 1031 exchanges, transparently, we actually haven't facilitated one yet, but we've had a couple investors come with interest, and so we've been exploring them with our lawyers. And it's a fair amount of overhead and complexity. So the short answer is yes, we can do this, but the investment size really does need to be higher because it's expensive for us and the investor, and it's also there's just extra logistics that we consider, as well as it'll be something for the investor to consider as well. What will the debt be used for? So the debt really is mostly used to buy the communities, and then we have another loan that is from the same bank, and I'll actually show the capital stack in a moment, that is for capital improvements. Next one, any risks coming in as a limited partner? Generally, as a limited partner, your risk is limited to the investment you make. So if you invested $100,000, the worst case scenario is you don't get your $100,000 back. I mean, that really won't happen in this situation, obviously. It never happened, but that's the worst case risk. As a general partner, especially for Matt, Ryan, and I, we're actually signing on the loans as well. So we have much more risk involved in the deal as being the operators and managers of the deal, but limited partners don't. So that's definitely one of the benefits of being a limited partner. Finally, on this page, can I invest through a retirement plan? Yes, you definitely can. You can do solo 401ks or self-directed IRAs. We can facilitate either of those. This is the accreditation process. I'm skipping through it because this is going to be available online. This is also our more detailed project plan. I showed the high level. This is more detailed if you want to see it. I did want to show this partnership structure because this is generally where a lot of our questions come up. So our fee structure, I mentioned before, we dropped our acquisition and loan guarantee to just 2%. Our asset management fee is 5% of effective gross income. And then we increased the preferred return from 8% to 9%. Minimum investment is $50,000. It is accredited investors only on this portfolio. Distribution schedule we expect to do monthly, beginning in month 6. So we do monthly. I think most people are used to quarterly, but we do that monthly. This is our capital stack. So on the left, this is sources. So we have 11.6 million for the acquisition loan from 5 Star Bank, and then 1 million for the capital improvement loan, which will be drawn out over 24 months. And then we actually we're calling it a seller and reinvestment here, but this is actually seller financing of another $3 million. The reason it's referred to as seller and reinvestment is because it's not secured against the property, so it's treated as a preferred equity investment that literally just gets an interest rate return, but no upside. So there's no ownership here, it's just interest, and that will be fully paid off with the cash out refinance. And then we're bringing in investors to take on this $5.1 million left for investor equity. So that's where you all come in, partnering with us. And then on the uses side, we have the purchase price at 18 million, really strong operating reserve of $500,000, renovation budget of 1.6. Again, some of that we actually don't think we're going to need, but we wanted to budget for it just in case. And then closing costs and legal and third party, these are estimates for third party expenses related to closing and legal and those environmentals we discussed, ALTA surveys, things like that. And then finally, the acquisition and loan guarantee. We have the pro forma in here you can see online, and then a bunch of other slides that kind of explain how cap rates work. Okay, I see another question coming in. How does the size of this acquisition compare to your past ones? What portion of this total units under management will this represent? Okay, so this is a great question. This is by far the largest portfolio we've purchased, or our largest acquisition. Historically, what we've done, we purchased a 4-community portfolio in Iowa last summer that we then added a 5th community to, and combined that portfolio has 300 units in it. And then in Missouri, Springfield, we started off with 1 property, added 2 more, and then added another 1. So that was a little bit slower as we were acquiring those together with the same group of investors. And those have another 220 units in it. So this will certainly be the largest acquisition we have. And then we have a few other smaller communities outside of that. So the follow-up question on that was what portion? Let me see. I think we have, with our latest closing, we have about 700 under management. So I gotta, Mark, you're making me do math here. Give me a second.
Well, Fort Scott is another 80 spaces for the RV park. And I'll answer his second question there. So 5% stake that's from Brett, Matt, and I. Three pillars. They are raising on the deal, so they've already raised $2.5 million on the deal. And Brett, I'm not sure how much, like Yoel and
yeah. So to answer your first question, after this closes, we'll be at around 1,200 units. So this would be about 40% of our unit count under management. The 5% stake that's just the Suncrest portion of the stake. I expect Three Pillars to have a portion as well, but they haven't given us a commitment yet. So it'd actually be higher than 5% once Three Pillars does their commitment as well.
Yeah. Brandon had a good question. I think the data for the housing and the income was up to 2019. So on the other slide, the demographic slides for Springfield, for example, the metro area, that's the most recent that you can find, like on Best Places. So it's 182,000 for the median home price and 42,800 for median income.
Double checking. We pulled CoStar data too, so I'm just double checking CoStar here. So CoStar doesn't do it at a city level as much. It goes 1, 5, and 10 miles. So I'll just share that real quick. This is what the population report looks like for Lebanon from the address. So within 10 miles, we have, as of 2022, 29,000 people. And then median home value about 122,000, household income 49,000. So relatively in line with what we were seeing for 2019 data based on CoStar.
Yeah, that's CoStar, and then there's Best Places as well.
Mm-hmm.
Which
and then there's the Springfield data too. This is
This is the Springfield, Missouri metro area best places data. That's what we were quoting in the talk.
Mm-hmm.
Okay. Any others?
Not seeing any others. We're almost to the hour though. If anybody has questions, definitely please let us know. Just real quick on next steps, we've recorded this. We'll have this out tomorrow with our recap. Again, if you're interested, I really don't want to apply pressure. I hate doing that, but like based on where we're at right now with our raise, we're actually about $1 million over raised right now. Again, if I was going to look at that and put a confidence level on that, I think we're closer to 80–85% based on the number of those commitments that have been 6 months old. But that said, if you're interested, please do at least make a reservation. Let us know how serious you are, and we'll do our best to make you make a room and make sure that you're able to invest with us on this one. We also have other opportunities coming up like yesterday, so we can talk about those too if we overfund this. Okay, I think we're going to go ahead and wrap it up. I really appreciate everybody's time. This is always really fun for us to talk through our business plan, our strategy, get your input and your questions. So we really enjoy these conversations. The best way to get a hold of us, let me just show and real quick our presentation. This is our email addresses. So if you reach out to me, Brett@suncrestcap.com. Again, I handle all the investor relations, everything. So really reach out to me, but Ryan's available as well if you have questions specific to him. You can also go to our website. It's just suncrestcap.com. Again, our email addresses are there. You can reach out to us with set up Calendly invites or meetings with us that way, and also create your reservation through that same flow. So with that, we will go ahead and wrap up, and I look forward to hearing from you all.